All right, this is a fundamental financial analysis of mankind. This is new holding for me in my small cap portfolio. I just wanted to quickly go over what the company does. We'll take a look at their peers, and then we'll look at some numbers and then some predictions. All right, this is just a pipeline, kind of what they have going on right now. This stuff isn't available for public use quite yet, but it is hopefully coming in the very near future. All of this is going to be inhalers, okay? And Afrezza is the um, biggest drug that they do have for public use that they're really pushing, and they have been for quite some time. What we're looking at right now is the reviews for this particular drug. WebMD 3.4 out of 5 overall. Drugs.com has it at a 5.8 out of 10. I wanted to take a look at some of the lowest reviews on this drug because I wanted to highlight some of the problems that they've had over the years. Number one, it is an inhaler and it's used primarily for diabetes. And so the idea being that there are young children that cannot necessarily take injections. And so an inhaler is a really good option for them. There's also some persons that have some issues with injection sites where there may be some scar tissue or for whatever reason, maybe they're shaking and they can't give themselves injections anymore. Then this is something that a doctor may prescribe in those situations. However, the adverse reaction so far has been lung damage, and that's what you'll see primarily in a lot of these negative reviews. But again, overall, fairly decent reviews uh, for this particular drug. Um, what I did was I pulled from Seeking Alpha just some of their competitors, peers, and I grabbed the two that seem to be the closest of these peers. So I got Iovance and Celldex Therapeutics. As you can see, they're roughly the same size, and they have a large number of employees compared to some of these other companies that are about the same size but have a very low number of employees. Um, so anyway, um, take a look. Want to go over just a couple things here. Where we at? Okay, here we go. Some things I include, some things I don't. Okay, so number one, I never include a goodwill in my analyses unless I absolutely have to. Okay, goodwill is amount of money paid over what a company is actually worth, and so they book that as goodwill. It's really more of a tax thing than it is anything financial. So I don't include that. The other thing I want to discuss just real quick is this other assets. Okay, now you can see here in 2023, the other assets were about 7,000, and it jumped way up to 26,000. So initially, the other assets um, were part of the. Um, I don't know if I pulled it up actually. Let's see. No, I didn't. Okay, so anyway, the other assets were part of their investment in Thyrona. Here it is. Okay, so Thyrona is a company that does lung image analysis. So they take these pictures of lungs to try to figure out different lung diseases. And so anyway, Mannkind has invested in this company, and so that is what has been part of the other assets for a number of years. And then what we see here is that in 2024, that number jumps way up to 26,000, and I can't figure out what the heck it could possibly be. The only thing that I was able to find was this investment in a facility in Danbury, Connecticut. Okay, now this facility was purchased by the company and then was sold to a financing company who was then charging Mannkind rent. Okay, and so maybe possibly what's happening here is that they're booking the this asset as the they're booking it as the value of the rent or the value of the lease that they will pay to this financing company. And I think what's going to happen is over the years, this other asset is going to slowly decrease to show um, the lease ending at some point, right? And then usually with the sale leaseback agreements, there is a contractual agreement that the company that is selling the building to the financing company can purchase it back um, for some stated amount or something at some point. So again, I don't know if that's the case, but that's the only thing that I could come up with. Otherwise, they did not specify what this number is. I mean, it's almost triple this 7,000. So that's that. All right. Um, the other thing, yeah, other intangible assets. Okay, so let me show that real quick. So the other intangible assets is this Ice First. Okay, Ice First is a company that they have invested in that basically manufactures inhalers. Okay, here's the issue though. Prior to them investing in Ice First, so we see here in 2023, um, the only thing that they had listed under uh, other intangible assets was this developed technology. They're not saying what this developed technology is, and so I did not include it in my calculation. Okay, what I did include, however, is the license for Ice First. All right. The other thing I want to say just real quick is that the way that these licenses are evaluated are guesstimates. Okay. And the only reason why I even included it, honestly, is because at least we know exactly what it is. And it's a small number. If it was like a huge part of the balance sheet, I probably wouldn't have included it. But either way, that's what's going on there. All right. Um, Now, what I've done is I've taken the last 3 years of financials and I'm using these numbers to come up with some predictive amount a year out. Okay, so the 2024 numbers is based on September of 2024 balance sheet. All right, and so you could see here um, in 2024, the cash on hand was 63,000. The average increase year over year is roughly 94%. Okay, it's jumped around quite a bit as you can see. It goes between roughly 200,000, 100,000, and 60,000. And so, if that trend continues, then we can expect the cash balance at the end of 2025 to be somewhere around double the 60,000. So we have it at 122. Inventory, um, same thing, jumped around quite a bit. And so we have that almost doubled to 38. And again, that Ice First license, we expect that to remain constant. We don't expect it to go anywhere. As you can see, in the previous years, I have it at zero, basically, not including that other intangible asset. We don't even know what it is. All right, buildings. That number has increased a little bit over the years. You can see on average it says 50%, but if you look at the numbers, it's been pretty consistent. It jumped from, roughly 30, 40 to 80. And so the question is whether or not that trend is going to continue or whether or not it's going to stay stable. I'm saying that it's going to increase just a bit. All right, receivables, kind of the same thing. It's been a small increase over time, uh, 4,000 to 14 to 18. So we think it's going to stay about there. So we have that at 18. And then this is the other asset. Again, I did include it here, okay, because I do think that it is maybe that sale leaseback of the Danbury um, building, but can't know for sure. But I did include it, and so that does kind of throw off our numbers a little bit. Um, and so what I'm going to actually do here, I'm going to bring this back to. We're going to do 23. And so that's going to show that basically it stays about where it is, but it's going to decrease next year because they're going to realize uh, those lease payments. All right. And then prepaid expenses, um, uh, again, all over the place, 200% on average. Uh, you can see here that it's been 3,000. It jumped all the way to 25 and 35, currently at 31. So we expect that to continue to increase as the company continues to ramp up and, and do some new things. All right, investments. This is primarily U.S. government um, debt, and so it's very safe. It's basically cash, but we put it under investments because that's the way they have it booked. It has slowly increased over the years, as you can see. And so we expect that trend to continue. And so we have it just slightly up at 23 from the 20 that it's at now. All right. Payables. We expect those to um, slowly decline as they have done. See here year over year. They have obviously done fairly well at reducing their payables, and that's a good thing. That's what you want to see companies do is reduce costs and increase assets and increase sales. All right, this for sale liability. This is actually the Thyrona, and I think what's happening here is that they're booking it as liability because they have an obligation to basically invest in the company Thyrona. And so that's why this is listed as a liability. Uh, Leases is exactly what it sounds like. This is going to be leasing offices and equipment. The debt has increased quite a bit, but you can see that it's kind of been all over the place, right? It was way up, then it's been coming down slowly, right? We see a big drop between 2023 and 2024, 11%. And so I expect that to continue, just like they've been reducing their accounts payable. I think they're going to reduce their debt as well. So 334 is where it was September 2024. By the end of 2025, I think we can maybe get it down. It's difficult to expect them to get it down to 207. I mean, that's a big drop. Um, but statistically, it can get there. Um, I'm going to leave it even. Okay. I think that's an easy enough thing to do. All right. Deferred revenue. I think I pulled this one up. I meant to talk about it. Let's see. No, I didn't. Okay. Let's talk about this because this one is interesting. Here we go. All right. So, I'm not going to read this whole thing, but um, so they're saying that their policy is to book revenue basically before they receive it based on plans that the company has. Okay. Um, and so what that means is that this is not a real liability, okay? But I did include it because I always want to be conservative in my analyses. And so if the company books it as a liability, then I keep it as a liability. Now, what happens here is that as the company makes money, they're going to decrease this liability. And so basically, this liability is what the company thinks that they can possibly make uh, in the future. Okay, is what this is. Now, the question becomes, has this number grown, right? And as we can see, on average, it's grown roughly 50% over the last 2 years. Um, and we see this fairly, I mean, it's kind of been all over the place, but from 35 down to 20, way up to 40, and then doubled to almost 80, and now it's currently at 71. And so the question becomes, does that number um, continue to climb? Does it come back? Again, this is all based on their plans for the future. Um, it's it's really tough to say. It really is. What I'm going to do is I'm going to leave it even because I don't want to be um, too conservative in thinking that they're going to plan to make more money. This is a really weird situation as far as analyzing because if you think the company is going to make more money, then you actually want to use a larger number, which is going to make your estimates more conservative. So I don't know. It's strange, but you didn't have to increase the revenue. So anyway, I'm just gonna leave it flat and go from there. Okay, so now here's the important thing. That makes these guys negative. All right, meaning that their liabilities are more than their assets. Now the question becomes: if I take off this, what we can call liability, this false liability, they're still barely negative. Okay, they're still barely negative, um, but still negative. All right, and that basically means that this company is pretty much bankrupt. Okay, let's go and let's do this um, through all the years. As we can see, currently September 2024, they are in the negative. Now, if I were to include the goodwill, maybe they're positive. But remember, goodwill is not a real thing, right? If they were to sell all of the investments and everything that they have, maybe they can sell it for what they got it for. Maybe they can sell it for more. What are the odds of that, though, right? So again, pretty much bankrupt. Um, but again, let's take this number off, and as we can see, still negative. Okay, same thing here, still negative. Um, and I'm certain I can do this all the way down the board, still negative. So um, a negative balance sheet is not great, right? Let's take a look now at our price to book. Okay, this is what the market is willing to pay for this company above the value of the actual book value. Right, the book value is literally this net book value. Now, being that the net value is negative, we already know that the market is even if the stock price is a penny, the market is already paying uh, multiple 100% more than what the books are actually worth. Okay, so we know that right away, and that's why we see this 20.89. Okay, it is negative simply because the book amount is negative, but it is literally 20 times, right? But the market is paying 20 times what the book value is actually worth here. All right. Now, based on that, that gives us a price at the minimum of 79 cents. Let me make sure uh, that's correct here. So You see 19. We're looking historically now. So this is the lowest the price has been so far in 2024. Gave us a price to book of 4, and the highest that the price has been is gave us a price to book of 9. Then we see in 2023's 3.5 and 6, 2.45, 3.6 and 7, 1.75. And so what we're going to do here is we're going to choose out of our statistical um, information here what is going to be a possible um, minimum, right? And so the smallest number we see here is actually this 1.07, 2.42 is the next. And so statistically, we see this 2.96 here. So we're going to use that. It's going to be F, okay, so that's good. And then the highest, we see 9, 6, 5, 7, and 5. So that brings us roughly to our 6.92. And so that gives us a max of $1.85. Okay. Now, the current stock price is $5.60. So clearly, this company is not trading based on the balance sheet, obviously, because if the market was trading this company based on the balance sheet, they would say this company is bankrupt. I never invested, right? But again, these are our numbers that we've come up with. Okay, so let us now turn to our profit loss statement because obviously that's what this company is trading on. Okay, all right. I want to take a look just really quick. Now, just want to say again, these numbers are based on September 2024. And so we are predicting, that's why these sales are highlighted. We're predicting what these numbers are going to be by the end of 2024. And I do that simply by taking the September 2024 numbers and then multiplying times 25%, expecting that the fourth quarter is going to be on average the same as the first 3 quarters of the year. All right. So it is a prediction, but it's fairly close. All right. So we see here in 2023, the revenue was 198, expecting that to jump to 260. Okay, so that's a pretty big jump, but not out of the realm of possibility based on what we've seen historically, right? So we go back to 2020, revenue was 65,000, jumped to 75,000 in 2021, and it jumped to 99,000 in 2022, right? So not out of the realm of possibility at all. On average, we can see 49%. So 260,000 is not a crazy number. All right, payroll. This is going to be salaries, of course, um, and I'm showing this on average has decreased over the years, which again is what you want to see. You want to see a company make more money, spend less. Um, and so we have that actually coming down just a bit, 87 from 94. I don't know if we'll actually get there, but that's where we are right now. Like I say, as of September 2024. Next number is tax. The tax has been zero for the most part. Matter of fact, in 2020, they got a tax refund. Uh, but now that we're making a little bit of money, they're paying some taxes. And so we expect that to continue to increase. And so we have it at, oh, change this to 26. There we go. All right. Yeah, same thing here with the payroll. It's currently at 87. But like I said, I don't really expect it to stay there. And so I have it increasing up to 110. Again, not sure if it'll get there, but matter of fact, you know what? Let's make it flat. Let's make it flat. Obviously, they've done pretty good with managing. All right, R&D, research and development. Um, this number again, on average, it has declined over the years, which means that they're actually spending more, right? Same thing here, actually. Yeah, it's declined, so they're actually spending more. So that's why I had it at. let the negative numbers confuse me. There we go. 23. Okay, we're good. All right. Now this one, 1561, 2384. Yeah, okay. So we're good. Okay. R&D has decreased. So that means that they're spending more on research and development. Currently it's at 43. And so we have it increasing to 53, which is the largest number we can get to statistically speaking. All right. Impairments. Yeah, they had impairment um, twice, 2020 and 2021, and it's been zero ever since. So we're going to keep that at zero. Their interest expense, because they do have quite a bit of debt, um, has gotten bigger, of course, because they've added more debt. So it's currently at 30,000, and so we have that increasing to 32,000, which again is the largest number that we can get to statistically speaking. All right, cost of goods sold. This one is important because we see cost of goods sold. This is the money that they spend in order to make money, right? So they're spending 71, but they're making 260. And we want to see that number either stay consistent or get better, right? So 62, 198. So they're spending a little and making a lot. 57, 99. This one is about half. This one is a lot less than half. And so that's what you want to see. That's what you want to see. So they've done really good with that. But it is going to increase as they make more money, right? So uh, 71, I have it going to 79, maybe gets to this 86 number. Not sure. We can play around with that. Okay, foreign currency exchange. They're doing business outside of the U.S. Matter of fact, that's where a lot of their growth they expect is coming from. They have deals in India right now, as an example, and so there's some foreign currency risk there. But they've done pretty well managing it, as you can see. We have some pluses in the last few years, and then we see a drop here in 2023. Currently, though, in 2024, they're positive on that foreign currency exchange. So what they're doing is they're investing in swaps and, and maybe even some foreign currency hedging in order to manage that. But we do still see it decreasing, and so we have them losing a little bit there on the foreign currency. Okay, so the net profit that gets us to a negative 61 for 2025. Now, this is what I think is interesting. Okay, for 2024, we actually have this positive. If you look back over the years, 2020 they were negative 27, negative 80, negative 87, and then 2023 we see this huge increase, right? Still negative, still not profitable, but a huge increase in profit up to 11,000. And then again, these are predictive values, but these are predictive values based on 3/4 of numbers. I think um, even if we uh, even if we get conservative about this, right, and we increase that cost of goods, um, you know, they're still looking to be uh, positive. At least it's a possibility, unless something happens out of the ordinary. Um, let's see if I can see where this is. It's up here. Here we go. Yeah, see this? For 9 months ended September 30, 2024, they are positive, positive income. Um, that means something, right? That means something. Um, Another thing I was looking at, see if I can find it. Yeah, there we go. So what I like to do whenever I'm doing these analyses is I like to look at what the professional analysts have for a PE ratio to see if I'm close, right? So for PE, I have 15.9. Of course, mine's going to be a little different because I'm using slightly different numbers in my calculations. There's some predictions, so forth, and so on. NASDAQ has this PE at 56, which is way high, right? Um, the 2023, because there was a negative profit, right? A net profit of negative, they were losing money. It's a negative PE, okay? The 2025 estimate, 24, okay? And so again, mine comes out to 1590, and I didn't do one for 2024, but 1590 is what I have. And the fact that the estimate is 56 means that there's some analysts out there that's expecting a net profit at the end of 2024, just like I am. But it looks like they're being a bit conservative going forward to 2025 because they expect what's going to happen is the stock price is going to catch up to the earnings, and that's what creates a lower PE. So let's talk about this real quick. Uh, Price to earnings ratio. The price is the numerator, and the earnings is the denominator. So if you have a high price and low earnings, meaning you're not making a lot of money, but your stock price is really high, then you'll have a really high PE. Okay. On the other hand, if you have a really low stock price and you have a lot of earnings, meaning the company is making a lot of money, but the stock price isn't going up a whole lot, you'll have a really low PE. And typically, that's what you look for when you want to purchase a stock because the stock price is really low, but the earnings are really high, meaning that most of that stock price is actually earnings. So it's less risky. Okay. So if they're expecting the PE to be 56 at the end of 2024, that means they expect that the price is going to go high while earnings are low. And this is currently based now. I'm not sure what they're basing these estimates on. I didn't go that far. Sometimes they're a quarter behind. So this might be based on second quarter, maybe even first quarter. Not sure. Either way, this is what they're estimating for 2024 in total, right? Okay. So they're expecting the stock price to be really high and earnings to be really low, but still positive, okay, versus negative. And being that it's been negative for the past 3 years, that means obviously they're expecting for Mannkind to post a profit in 2024. Okay, but they're expecting the PE to come down in 2025. So they expect that the stock price and the earnings are going to be closer together, right? So that means that they're still expecting a decent amount of earnings, but the stock price is going to move up so high that they're going to sort of meet in the middle and come down to that 24 level. So again, the excitement and the idea behind this company right now is that they're turning profitable, right? With that being said, 2025, I still have them at a negative. And to be honest with you, I'm not sure exactly what, if anything, I can do um, to get them profitable other than like doing the best case scenario as far as income goes, right? And that gets them, profitable, but barely profitable relative to what 2024 is going to look like. Okay. And again, maybe that's what they're thinking too with that 24 PE. Either way, what we have here is a prediction on price. And I have to figure this. So 74, 7, 9, 7, basically. And so that's going to put us right around the 7 mark. And do we have a 7 here? No, we do not. that's a problem. I think only way to do this, I think this might be on the let's see, shares 352. It gives me a PE of 1.59. Oh, let's see. Yeah, it does get me closer. So what I'm doing is I am simply changing the ratio on the shares. And the reason why is because we have, yeah, we have negatives and positives, which is wreaking havoc on the prediction. So let's see, 7.7, 1.7. So minimum 7, 1, 1, maybe 7. Okay. So that gives us a minimum of is 1.79. That's still giving me a negative number. And then on the positive side, let's see, we got 2 in 2024, 13, 2, 2, and 4. So that's the highest price that it has been, the highest PE rather, it has been over the last 3 or 4 years is this 13. Um, but 4 is definitely closer. And it's because the the earnings are positive. So what I'm gonna have to do is I'm gonna have to make that a negative number. But even doing that, still get me like a really low price. This is F. And if I make that a negative number, yeah, that gives me a predicted price of 66 cents to $1.33, which is ridiculous. Um, and I'm getting the same thing here on the book too. And so, you know, that's that's the problem sometimes with the analysis. Um, it doesn't make any sense at all, and it's just because we have a positive earnings per share, but we have negative um, earnings um, for so many years, and then you have this positive now, and so um, you know, if the earnings per share, see 2024 earnings per share are $3.52. But if you look back over the years, it's been negative, -1, -3, -3, and here was barely negative. And now all of a sudden it's three. That's like 1,000% change. And so it's messing with the statistics. It's way off, right? So and in 2025, we're saying earnings per share is only going to be 37 cents. So if you take 37 cents and you multiply it times the PE of, let's do 15, that gives us $5.60, and same thing there. So $5.60 and $5.60 is what it is now. So let's use now the NASDAQ PE. That gets us to $20. Actually, I ought to make this one 56. $20. And then if I use the 2025 number from NASDAQ, it gets us to $8. And even these doesn't make a lot of sense. I find that very hard to believe. So what I could say is this, is that as far as predicting this price, it's near impossible to do. And I think that's why we see such a disparity in the PE estimates from the NASDAQ. All right, let's move on. The other thing is the insider trading, right? So these are officers and people who work for the company, maybe board members, and they are buying the heck out of the shares within the past 12 months. They purchased 2 million shares and they sold 1 million. So they're buying double of what they're selling. Okay, let's take a look at some of their peers. As you can see here, this one is Celodex. Insiders purchased 11,000 shares but sold 364,000. Doesn't seem like they have a lot of faith in what's going on with the company there. Iovance purchased 5 million shares and only sold 200,000. That's way better. Let's take a look now at Iovance. They are, okay, just went away. All right, there you go. They are a cancer company working with solid tumors and using cell therapy in order to do that. Let's see. Yeah, there was nothing that I really needed to talk about there. So again, looking at their PE, what I got was negative 443, and NASDAQ got negative 434. So very close. Then you see -6 here. So it just kind of lets me know that I'm on the right track. The other, see, Celdex, I got negative 8.5, and NASDAQ got 8.3, 8.9, and then 6.6. So again, not far off, and that just lets me know that my math is good. All right. What else? Is there anything that I want to talk about here? Yeah, let's talk about Iovance, because Iovance looked really good. And I want to show the difference between Mannkind and Iovance. Okay, so first things first, Iovance has a positive balance sheet, and it's not growing a lot, but it's decent and it's positive. Okay, and that's what you're seeing here. It's just the oh, sorry, right here. There we go. The net. So you see, it's on average is declining, but it's done a little growing. 645 to 619, way down to 500, way down to 4. See, it's come back a little bit in 2024. So anyway, so positive balance sheet, right? So that's really good. And then we take a look at net profit, and we see they are losing a lot of. Look at it, 259, 342, 396, 440, and this is a predicted value 2024, a small increase to 367. But again, not profitable. It doesn't seem like they're going to be profitable anytime soon. And that's why we got the negative PE there. But again, the insiders know something. And I think it's even maybe this small increase, right, that we're seeing from 2023 to 2024, that's maybe giving them the confidence to go in and buy as many shares as they're buying. Because, um, again, positive positive balance sheet. So they're solvent, right? Um, the other thing that's interesting about this company is the debt. Okay, have no debt. They have this one um, debt instrument that they took out back in 2021, only for 1,000, and it has stayed the same. It has not moved. They have not paid anything on it, and they have not taken on any more debt. And so that lets me know there's probably more of a credit line than it is a loan, right? So it's just like a credit facility that they can use, but obviously they haven't used it much at all, if any, because it's just stayed the same over the years. Um, the other thing that was really interesting about this company is the investments and the cash on hand. Okay, so that's predictive values. Let's look at some real value. So this is 2024, 2023. So this is cash on hand of 170. And these investments are, again, U.S. Government debt. So treasuries, government bonds, things of that nature. Okay, 170, 233. The total assets are 684. That means that roughly two-thirds of this company's assets is literally cash, right? And that makes it a very safe investment because if I'm investing, let's say, $1 and 75 cents of that dollar is just cash in my pocket, that makes it a very easy investment to make, even though they're losing money hand over fist, right? So the one thing that we can look at this one. So the one thing that I think really tells the tale is when you look at these numbers right next to each other, right? So here's the price of the companies here, okay? The current stock price. Here's the PEs. I'm sorry, this is the price to book. Then here's the price to earnings, okay? And then these are the predicted stock prices. So this is the stock minimum, so the least that the stock will trade at statistically. And this is the most that the stock will trade at statistically. Okay. And again, same thing for based on the book value and based on the earnings value, right? Now, for iAdvance, the price to book is three times the actual book value. So the stock price is three times the actual book value, meaning that people are willing to pay three times what the book value is actually worth for this company. And the reason why I think is because it is literally just cash on hand. So you're investing in a bio uh, medical company dealing with cancer, but it's like holding cash in your pocket. So people are buying it based on that. The PE ratio, the earnings are not great, right? And that's the reason why it's negative. That can be seen as a good thing, meaning the company is really cheap, or it can be seen as a bad thing in this case because they're, again, losing a bunch of money. All right, current price is $5. The minimum is roughly 3 to 5, with a max being 14 to 13. Because all four of these numbers are pretty much in line with each other, I will go so far as to say this is about right. There's a lot of upside potential for iAdvance. You pair that with the fact that the insiders are buying a bunch of shares. This seems to be the company that has the most promise, the most upside potential. Okay. Sale decks, current stock price $22. Price to book is double what it is, but we see the PE is way down. Um, and then we look at these this minimum and the maximum, and it's just all over the place. It is unpredictable, and I think that says a lot about what we see in the financials sell decks as well. It's anyone's call, you know. I sincerely doubt that we're going to see this company, quadruple over the next year and make it all the way to 76. But the idea that they're going to triple the stock price and make it to 58 is also I can't see it, right. The minimum is 17.99 or $18 roughly, which seems fair, right. And then of course we come to Mankind, which price to book is negative, but price to earnings is at least positive. Um, relative to the rest of these guys, which again makes a lot of sense. Even though Advance looks really, really good, they're losing money hand over fist. Mankind is at least moving towards profitability. And that's why we have a positive PE there. Again, the problem though is that trying to nail down what the stock price is going to do is almost impossible, right? What we're seeing here are the numbers based on the NASDAQ and not based on the numbers that I got. So, um, you know, a minimum of $8 when the current stock price is $5 is saying that the stock is currently undervalued by almost 100%. That's crazy, right? There's no way. And the idea that the stock is going to quadruple to $20, I don't see that happening either. Um, the upside potential for Mankind, I don't see a lot of upside potential. Maybe it gets to 750, right? Um, what I can say though is that for my portfolio, I'm going to continue putting money into this thing to dollar cost average down, um, and I will continue to watch this. If the price continues to drop, well, I'm not even going to say that. If the year end 2024 numbers come out and this thing is profitable and the stock price does not move, that's going to tell me a lot about the future of this company, right? If the 2024 year end numbers are negative, they show a negative profit, then that will probably cause me to say I'm out, right? So, anyway, that's it. Mankind, from me to you.